Good afternoon, everybody. Welcome to my channel, Data Driven Decisions. Um, I've been given some investment advice lately. Um, you know, I I've read a lot about investing, and I think I know what I'm talking about. And I think um, what I'm saying to people is very helpful to people. It's a very nasty, treacherous endeavor to seek helpers for investing. 97% of all investment helpers are brokers that are going to put you in high cost funds and uh, siphon out a lot of your money. Um, that's the norm. If you're in that boat, um, you know it's common. But there's a better route. As an investor, all you deserve is your fair share of the market, just the market average. That's all you deserve. And going for anything above and beyond that is greedy, and you'll probably pay for that. It'll probably be a mistake that the financial algorithms will capitalize on. Um, I would say to any new investor, put all your money into VTI, the Vanguard Total Stock Market Index ETF fund. Um, Jack Bogle was on Consuela Mack, and she always says at the end, if there was one mutual fund or stock that you would tell investors to invest in, what would it be? And Jack Bogle, was very exuberant with VTI. And for any new investor, um, all you deserve is your fair share. And if you want to get your fair share, you will get your fair share just by putting all your money into VTI, the Vanguard Total Stock Market Index Fund. If you get average, with VTI, you're going to probably do better than 80% of people that year. Sad to say that most people underperform the market. Most people are in active management, and active managers are all competing against each other. And some do good one year, some do bad one year, but on average, they do average. They get the market return, and that's just as good as investing in VTI. But VTI has one major benefit, and that is it doesn't have the high cost expense ratio. With active management, you're going to have to invest or have 3-4% taken away from you. With expense ratio and transaction costs, there's a lot of hidden fees, and you'll end up doing far worse than the market because, on average, I'm talking to the average person. If everyone who listened to this probably put all their baskets together, it would be the average. But minus expenses. And when the moral of the story is, if you do active management, you're always going to get 3 or 4% behind the market average, and that's a big difference. It's the difference between 10% and 6%, and money doubles a lot quicker at 10%. I think it's every 7 years. I think with 6%, it takes over 10 years. So you think in 40 years, it's a very big compound difference. So um, I want investors to do good, um, and I don't want people basically robbed of their retirement and their investments by just getting the wrong help. And if you're in that boat, I hope you get out of it and realize that you can invest on your own entirely and do better than them and be able to sleep better at night, knowing what you do is sound. It's got the pros endorsing it. The best, the most important thing about investing is what do you do when the market crashes? most people panic and sell very low, and then what always happens after a depression is a huge rebound, and people who duck out of, the market crash, well, they fail to get in while it rebounds, and you end up in a very low place. What you need to do is stay the course. Um, don't do something, just sit there. Jack Bogle says that a lot in his videos. You shouldn't do anything. You should. He has a book. His last book that he wrote before he died was called "Stay the Course," and he says that all the time. And what that means is, when times are bad, when there is a market crash, do nothing. Just stay the course. Keep putting in whatever money you can in investing, because it's the best time to buy. It's a fire sale when there's a market crash. If you're a young investor, you should be hoping for bad returns, because that just allows you to buy more shares on the cheap. For older people, they of course want, a good market, because they only have, maybe 10, 20 years of horizon. Um, so I think, for any new investor, if you want to know what to do, I would open a Vanguard account, and I would invest in VTI. If it's whatever the money is from, it could be like a rollover from an old 401k company. You can bring that into your Vanguard, and then manage it yourself. You really don't want the 401k company to keep managing your old money from your old job, because all that stuff comes with pretty high expense ratios. Yes, you should still, invest in your company 401k, especially if, you need to get a match. You need to put in something in order to get a match. You should always get that free money. Um, However, Tony Robbins revealed that, for most 401ks, it is high expense land. There's a lot of hidden costs and high expenses, and um, it's like 3-4%. And on the upper side, if you're getting a match from your employer, that's usually like 100%. So it's still advantageous to, invest in your company 401k. However, when you leave that company, you should get out of that 401k and bring it into your own management, your own universe. I took my old job's 401k and I brought it into Vanguard, and now it's called a rollover 401k. And I have a pretty cool asset allocation for that portfolio. I'm happy about it. I think I rest on it. I don't feel like changing it, and I'll show that to you. Uh, you know, despite saying, hey, if you're new, you want to make it as simple as possible, just VTI. Uh, you know, I I like to be more sophisticated than that, but if I were to be honest, it probably is to my detriment. I probably, because I am not um, in perfect asset allocation with the total stock market, which is exactly what you get if you invest in BTI. I'm diverted from that, so um, I'm hoping it will give me higher returns, but more likely than not, it will end up in lower returns, and I'll be upset that I even um, had a sophisticated asset allocation. Um, there's some flaws to what I'm doing. I'm basing my my portfolio on past performance, and past performance is not a great predictor of future performance. Not at all. Some say it's kind of like the opposite, reversion to the mean, where last year's top performers do very poorly, and last year's bottom performers always do better than average, and it's a weird phenomenon. And um, it's weird. As an investor, all you deserve is your fair share of the market, what the market averages. And if you go any more than that, you are getting greedy. And I'm not going to say that what I'm doing is right. I feel good about it. I like the work I put into it, the math. I like the research I did, and that's what I'm going to share with you right now. I think it's sound, but there's downside to it. I'll show it to you right now. Okay, so just to sum up my portfolio, this is what it is. It's these portfolios in red. So, what research did I do? To the left over here are about 550 um, portfolios from investment gurus. A lot of the names I know, like William Bernstein, Jack Bogle, a lot of just different like investment funds. There's just tons. So this is my sample size of portfolios. I got it from Portfolio Einstein. They're all ETF portfolios. They're all index funds. So that's really cool. That's all I want to play. And, it gave me the standard deviation and the return since 1989. And those are the two numbers that I plotted in a scatter plot. And, on the x-axis is risk and on the y-axis is return. And what you see right here is the efficient frontier. To the left and up is this straight line, which is known as the efficient frontier. That's, Harry Markowitz and his, Nobel Prize was on modern portfolio theory and how to, maximize your portfolio based on, looking at it such as this. He puts in a lot of, correlations and covariances, and it's sophisticated. And I've played with it online, but plain and simple, I just hand selected the stocks I wanted to pick. I said I wanted to pick, I think 20 or 25, and I just kind of, said, okay, first one obviously was probably this one. I just found out what it was, and then I take it to the work. So, here are all the portfolios I selected. There's 20 of them. And I just found out what was in what, just by starting with the first, 30% VTI, 40% TLT, 50% VGIT, 7.5 DBC, 7.5 GLD. So that's portfolio one that I picked. And then the second one, it had some added ETFs, and I just added them to the right. So, there was a lot to add for the second portfolio. And so I just built this matrix. And it got pretty long, but it has every single portfolio, um, you know, and then at the bottom, I just took the average, which is just the sum divided by 20. And this is my portfolio right here. This is my asset allocation right here. And, I just transpose that. And here is, all the ETFs that I'm buying, and then here's the allocation. And then I figured out the price at the time and figured out how many shares that I needed to buy, target, and then actual. And that's how I started my portfolio. So, I think that's pretty cool. I like the way I did it. It's not too tricky. Um, but there's a drawback. I'm picking the ones that had really high past performance. And I don't know, from what I read, I could do just as good probably by doing the exact opposite, by picking the bottom performers. It's a random walk. So, this is more sophisticated than investing in VTI, just picking the high return, low risk portfolios from past, from I think 35 years. So a good amount of time. These are just ETF portfolios, so there's not active management. So it kind of is like a true holistic return, and it's not like a random guess. It's holistic. So I feel good about that, thinking that, past returns could equivalate to future good returns. Where is this going to get me in actual return, I'm hoping at least 8, 9 looks like the average, would be the average return. And that's why I say, 10% they say is the stock market. That I think that's a little too much. Looking at this plot, it looks like, 8 is the average return for a portfolio, not 10, and certainly not what Dave Ramsey says about 12 or 14. He's blowing smoke. This is really the true risk and return of most portfolios, what you see right here. I mean, this is 550 just broad ETF portfolios from the investment gurus of what they propose, average investors invest in. You know, I made that my sample size, and I just chose the best basket of 20, the ones that I wanted, and you see those in red. So, you could do something like this. I think you can get this table that I just pasted on Portfolio Einstein and, plot it, get to this scatter plot, and then select your portfolios. And once you select a portfolio, start building out this matrix and just finding through research, finding what each portfolio you choose is made out of, and determine the weight you want. You can make one more weighted than the other. Like make it like 25% of the portfolio rather than 5, and you just come up with this average portfolio. And this is the final equation. This is what you're going to use, and then you turn that percentage into shares by getting the price of every ETF at the time, and that will tell you how many shares you need to buy, and then you buy those shares, and then to maintain it with or with changing the asset allocation, or not changing it but readjusting it. It's a process such as this where you find the price, you find your pre-shares, you got your target amount, which is always the same. Asset allocation, that should be always constant. And it's just, everything readjusts. The stocks the ETFs that do really well need to be maybe sold 1 or 2, and then the stocks that do poorly need to be bought for 1 or 2 shares. And it's just small adjustments, but they say that really makes a big difference, because with inside of your own portfolio, you're buying low and selling high. And that's really good. That's kind of the moral of the story of investing. It sounds really easy, but it's really hard to do. Yeah, that's my portfolio. It's basically this plot. So, that's what I'm doing. But to the average investor who's just starting out, doesn't know what to do, VTI is the one to go. I wonder if, let me find the VTI portfolio. There is one of these portfolios is simply just VTI. And I didn't choose it, but to be honest, it's like it's one of these babies. The VTI alone, it is one of these high performers. It is a great one. Just that alone is so good. I mean, that's perfect stock diversification. If you just invest everything in VTI, you can't get better asset allocation, more perfectly diversified. So anything that's not that, you're probably going to pay for it. So even what I'm doing, it's probably going to do worse than VTI. I'm getting greedy by trying to get better than average returns, and I'm probably going to end up getting below returns just because I'm not investing in VTI. And hopefully in the last 30 years of my investing career, I learned my lesson and just put everything in VTI. Um, but I like to have fun with this and do a little bit more than that. But um, yeah. So yeah, that's my portfolio. That's how I picked my portfolio. You know, who knows how it does? It probably won't do as good as VTI. VTI is the best asset allocation you can get. You can't really get more efficient than that. So anything that deviates from that probably does worse. And you know, I don't want to say what I'm doing you should do. It's probably going to do worse than VTI, but I just like to have a little fun. I don't think it could do much worse than VTI. I don't think I'm going to lose my shirt with that portfolio that I selected. They're all just ETF portfolios from expert gurus. Um, I think I'll just get average returns, and that's all I'm hoping for. You know, 8%. That's your fair share. And I don't have any helpers, so I'm going to get a true 8%. I'm not going to get 8% minus 4%, so 4%. I'm going to get my fair share of the market, and that's all you deserve as an investor. And just go for that and sleep at night and stay the course. Just invest in the total stock market. Keep putting money. The more you put in every month, the greater it will grow. That's the number one factor of, you know, whether you retire in with a lot of money or not. It's just how much money you keep putting in. You know, believe in what you're doing. Believe in VTI. Believe that you don't need to change it, and just go on a Dave Ramsey debt snowball, but with investing, and just keep throwing money in there, keep throwing money in there, especially when times are bad, especially when there's a market crash. That's when things are fire sale, and that's when you need to buy, 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 buy. Be greedy when everyone is panicking, and be very hesitant when everyone is greedy. That's the rules. Alrighty. Well, I hope you like this video. Thank you for listening. Have a good one. Bye.